My name is Max. I'm an accounting student at Cégep Garneau. Today I will talk to you about the difference between income statement and the balance sheet. I'll start by explaining what is the income statement and what is the balance sheet. After, I will explain what their utilities are in the accounting cycle. After all, I will show you the link that unite this financial statement. So, there are four financial statements in the accounting cycle. The income statement, statement of returned earnings, or statement of owner's equity or equity statement. The third statement is the balance sheet, and the last one is the cash flow statement. But I will not talk about the last one because it's not necessary to know that to understand the difference between the balance sheet and the income statement. This is used to know the amount of money that the company has made for a period of time, like a month, a quarter, or a complete year. In other words, this is all the income from the business, all money which generated by the sale of product or service, minus the spend of the company, all money which was needed to operate the company. Example, electricity, taxes, insurance. Equity statement. I believe that it's necessary to talk about the equity statement because it's the link that unites the income statement with the balance sheet. But I will come back on this later. I'll start by explaining what owner's equity means. It is the owner participation in the assets of his own company, which corresponds to the excess of assets over liabilities. Net profit or personal contribution of the owner in his company are the two only things that can increase the value of the owner's equity in his company. Otherwise, withdrawal and net loss are the two only things that can reduce the value of equity. So, don't forget that the equity statements serve to demonstrate all events which have increased or decreased the owner's equity value. Now, the balance sheet. Balance sheet is done at a specific time, as a picture, not for a period of time as the income statement and the equity statement. The balance sheet shows what the company has, its debt, and the value of the owner's equity. Because the profit or the net loss, which are found in the income statement, are moved to the equity statement because it is an event that has increased or decreased the value of the owner's equity. And as seen later on, the value of the owner's equity is an element in the balance sheet. In sum, there are two financial statements that are very different. Income statement shows how much money the business has made or lost during a given period, while the balance sheet is used to demonstrate what the company has, its debt, its need, and the value of its own equity during a given moment as a picture. However, there is a strong link between the income statement and the balance sheet. The income statement and the equity statement are the steps that allow us to determine the value of the owner's equity, to then place it in the accounting equation, or if you prefer, in the balance sheet. Thank you, and don't forget to watch my other videos.